Good morning, everyone, and welcome to the monthly economic briefing from the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Associate Rob Knapp. It's great to have you with us this morning. Will also be great to have with us our Chief Economist, Gerald Cohen, who will be up in a moment. He's going to talk about the jobs report this morning, which had a very, very big number in it. So I'm sure he'll have a lot to say. He'll also be talking to us about the effects it may have on the economy and a lot of other things. So it's definitely one to look forward to. After Dr. Cohen finishes his presentation, then the show turns over to you. We will take your questions and he will answer them. You don't have to wait to submit those questions. You can start doing it now. And you can do that with the Q&A function at the bottom of your screen. We do prioritize questions from the press. So please include your name, your title, and your organization with your questions. If you're joining us by phone today, you can ask a question too. Go ahead and email it to me. I'm at rob_knapp@kenan-flagler.unc.edu. And if we're going to try to answer all the questions we can, we usually wind this up at 9:30. We will shoot for that again today. But just to let you know, if you get a question toward the very end of the show, it's possible we may not be able to fit it in. So that's everything you need to know. I kept the intro short today because I think we're going to want to give Gerald time to talk. So without any further ado, I'll introduce to you our Chief Economist, Dr. Gerald Cohen. Good morning, Gerald. How are you doing?
Good morning, Rob. Just wanted to make sure my video got started.
And before you got rolling, I have to tell you, I did get this email a few minutes ago from one of our regular attendees. There are no words in the email. It's just a subject line that says, "I can't wait to hear Cohen explain this." So what better transition than that?
That is a perfect transition. Well, let me start my screen and we can go straight to the PowerPoint. So it was definitely a humdinger of a report, and you know, I think what I had anticipated to state before we got these numbers. So 517,000 payrolls, well above expectations, was that for every month that we get some strong number, and I was anticipating something in the 200,000 range, that's another month that were well, let me put it this way. Payroll numbers don't go from plus 200,000 to minus 200,000, and they clearly don't go from plus 517,000 to minus 200,000. So what I'm trying to illustrate is that it's another month. Not only does this tell us some information about this month, about the month of January, but it also tells you, kind of gives you some information about the future, because if we're creating 517,000 jobs in January, we are very unlikely to go into recession in February, March, April, or May. I don't want to speak for that far. But the likelihood that job growth is just going to stop on a dime is very, very low without some crisis. So this number is a very positive number. I'm still going to retain my view that we are going to have a recession, but as you've been hearing from me, it's likely to be in the second half of this year, in early 2024. That's what I've been on record saying since the yield curve inverted. But this report is very, very positive in terms of the employment numbers and the economy. However, and I'm going to say that this is important. However, this is likely to be a case where good news is good news for the economy and bad news potentially for the financial markets, because this is putting the Fed on watch that they're not done yet. And as we said in the release, and the invitation, and as it says at the top of this chart of this chart, the Fed is shifting the focus from inflation to the labor market, And this has got to give them the heebie-jeebies, because this is illustrative that the labor market is still extremely tight and that there are risks from the labor market pushing into inflation. And that's exactly where I wanted to start. So this is not about today's data, but it's about what today's data implies. So there is a very strong relationship between unit labor costs, which is not just wages, but it's wages adjusted for productivity. So it actually, what's the impact after productivity, after workers, if there's a lot of productivity, then wages are less likely to flow through into inflation. But so this is the relationship that you can see between unit labor costs in orange and inflation, and you can see there's quite a tight relationship. The correlation coefficient, for those of you that are interested in that, 0.82. And so this is why the Fed is worried about wages, because they're worried about it pushing through to inflation through essentially unit labor costs. Now, if we have really strong productivity, and as we did in the fourth quarter, then even strong wages can push down. You don't have to have inflation because of the high productivity of those workers. But if we have more average productivity and strong wage gains, then that's likely to push up inflation. And Fed Chair Powell was kind of talking about measures of inflation in which they're looking for this pass through between wages and pass through from wages. So that's, you're going to see in particular in services, such as haircuts or even in the tech world, because a lot of that comes through, a lot of those wages play a significant role in terms of how the inflation that we see. So this is a very important chart for the Fed, and something that I wanted to point out, or in terms of thinking about the Fed, and something that I wanted to point out early. The other thing is the wage gains that we saw. So you're seeing some slowdown on month-to-month gains in average hourly earnings, which is our kind of first peek at wage gains for the month of January. They were up 0.3, a slowdown from December and in the previous 3 months when they were up 0.4. But they're still up 4.4% year on year. And just to put that into perspective, and is that they were growing in the 2010s at 2.4% year on year. So wage gains are still well above where they were in the past, and still, unless we get that productivity, are likely to keep pushing higher on inflation. And again, this is where the Fed is worried that it's more about the services. We're seeing disinflation, declining inflation, or actual deflation in goods as shortages are abating. But it's those labor costs that are pushing into inflation, which is what's worrying the Fed. The other thing that potentially is worrying them, besides this 517,000, is that job openings increased in January. Unexpectedly rose, and that actually should be in December. I apologize. And suggesting a continuing strong labor market, which was exactly what we saw in January, and that is suggestive that it's going to continue into the next few months. As I said at the start, the likelihood of a recession goes down when you see these numbers, or in the next several months when you see these types of numbers. So as I indicated, exceptionally strong job growth. Not just in the month of January, but previous months were revised up 71,000. And then to give the Fed even more headaches, there were revisions to the year ending March of 2022. And so the revisions of plus 568,000 jobs. Now you could say, why does this matter? Because it's history. But the reason is because this just suggests more tightness in the labor market. We're now over 2 million above the peak employment that we saw in 2020. The peak in 2019, the pre-COVID peak. And given those numbers, we're starting to say, look, we're eating into the available labor force. And if we continue to have 517,000 jobs, that's clearly the case. And again, and the worry from that is that you see higher wage gains, which push into higher inflation. Now, I don't want to say wage gains are bad because, good for people to get those wages. It's just when they turn into this wage price spiral, that's problematic. I've talked a lot about temporary help jobs, and we've seemed to be seeing a peak in that. It's a good leading indicator, but it is showing a mixed picture. We had 2 months of decline. There were revisions. It had been 5 consecutive months. Now it's revised to 2 months of decline. And then last month and in January, it was up. So, is it rolling over? Hard to know, but this is the one worrying sign of all the signs that we've seen over the last several months in terms of the labor market. But the 517,000 trumps this number, I'll say, but it is the one thing that has been worrying me in terms of, or one negative indicator of the labor market. I've talked a lot about tech, just want to show you the updated numbers. So despite all the layoff numbers, we're still getting growth in tech skilled jobs. So this is not a measure of employment in the tech sector. It's employment of tech skills. So if you're a programmer for GM, then you are considered, that's considered tech employment. And I tried to cut the data so that we're actually getting this measure. So those jobs, while tech companies may be laying people off or hiring freezes, those jobs are still in demand, albeit at a slower pace. The other specific sector we've been focusing on is the impact of higher interest rates on housing. And the same thing is true. Construction jobs and continue to grow. And that's because we have a shortage of housing. So maybe you could say what this means is that the most interest-sensitive sector in the economy, or one of the most interest-sensitive sectors in the economy, which is housing, is clearly slowing, but in the job front, less so. And the pass-through from construction to inflation is more challenging. There's an attenuation between wage costs or construction costs and housing inflation because of the way housing is measured, and because most people's housing is not new construction. So it's a little bit more complicated relationship. Again, why Fed Chair Powell has focused as kind of taking out housing from his preferred or the measure of inflation that he's looking most closely at. But it's illustrative that it's hard that the Fed their hammer is having a hard time getting inflation down because this interest sensitive sector is still showing at least strong job gains, less so on the general activity. The unemployment rate declined to 3.4%, a new 50-year low. But I have to acknowledge that December to January changes are imperfect because of this benchmarking. The Bureau of Labor Statistics comes out with new population numbers, and they do something weird, which is they just kind of glom them on to the previous year, and so these comparisons are more challenging. And what they said was that it's effectively unchanged from the previous month, but it's still a 50-year low. So the unemployment rate is hovering around this 50-year low. Whether it declined from December to January is debatable, but it's very low, again, suggesting the tightness of the labor market. Same with labor force participation numbers. They were essentially unchanged. Whether they rose on the official number, but these revisions suggest that they're really unchanged. And they're telling this picture of 55-year-olds and older are still remaining out of the labor force. And that's a problem because we have more of those. And those are folks that, tend to move out of the labor force. And that, we're just demographics. We have more 55-year-olds, and that number is gaining. To get labor force participation up, or to get the labor force to increase, we need more people of the 55 and older to participate, and we're not seeing that. Meanwhile, prime age labor force, again, remains below previous peaks. that's worrying for the Fed. They want those numbers to be up because that's going to soften the inflation numbers. It's also good for people, good in terms of general employment, general income numbers. So that's kind of a healthy, you want to see increased labor force participation because that's indicative of health in the economy, more people, more jobs. And it also relieves some of the strains on the labor market for the Fed. The gap between strong hiring and GDP growth is narrowed. We had this period in which that chart is not the right number, the right one. So we'll revise it and send out the correct one. But you saw this gap last year. It's narrowing. The key thing is that the strong employment numbers that we saw in January and strong hours numbers suggest a very strong first quarter GDP. I don't think we're likely to have 4.6% growth, but if you just take the fact that we had this employment, that's suggestive of strength in GDP. Let me stop there. Well, maybe I'll just go with one last chart in terms of the Fed, although this is actually these numbers. The market had been pricing in, continued rate hikes at a fast decline for recession, with a concern that the economy was going to slow quickly in the second half. I'd be interested to see how this chart has changed since the employment report, whether, again, good news for the economy may not be good news for the Fed, or is not good news for the Fed, and potentially not good news for the markets because they're likely to say, Fed has more to do. So let me stop there and open it up to questions.
Very much, sir. Thank you for that. I know that you had to rewrite some script there in the last few minutes, and that was a great job. Have to do a few quick rewrites in my time, so I give high praise for that. Let me tell.
Unfortunately, you can never write a script, but you could have to quickly change the thoughts in your head and say, okay, how are we doing? What's happening here? So.
Yes, this is probably a great morning to point out the problems with script writing in the first place for something like this. Let me tell folks that you are invited to ask questions of Dr. Cohen now, and I think we could use a few at this point. Maybe you're all stunned by that 517,000 number this morning, but please go down to the Q&A function at the bottom of your screen and ask away. We will try to get those on. Also, if you're with us by phone today, you can email questions to me at rob_knapp@Kenan-Flagler.unc.edu. Gerald, if you're the Fed this morning and you wake up and it seems like things have been going in the right direction and see this number, is there frustration? Is there, I don't know. I don't know what they're feeling at this point.
I don't think it's frustration. I think it's a little bit, it illustrates the challenges of policymaking. And there is one actually last chart that I was going to show, and this actually helps on this question. I knew I was missing one. I think what it says is, they're not. The economy is not slowing, and this puts them in more of a bind. Unfortunately, that bind is created by what they did or what they didn't do a year ago, which is they were slow in raising rates because and let me be very blunt, I anticipated that the inflation would come down sooner rather than later. It didn't, and that forced their hand. And the problem is that in order to maintain their credibility, they're having to raise rates probably more than they would have anticipated, because they're saying, look, inflation is likely slowing. The economy, they could say, was likely slowing, less so now. And then so if it hadn't been for kind of past mistakes, maybe they wouldn't be maybe they would be kind of looking back at this saying, look, we've avoided a recession. We're likely to have the soft landing that we want. But 517,000 is not so soft. That's the challenge. I neglected to point out this chart, which is general policy uncertainty. But what I wanted to point out is that, and this goes to your question, Rob, that this is likely to create more uncertainty about Fed policy, and uncertainty is bad for the economy. It's because what happens is it causes people, businesses, and consumers to kind of say, well, I'm not sure I can make a decision about a long-term investment. And I expected to talk about this in the context of the debt limit and potential default, which raises uncertainty. But this throws more uncertainty in the Fed policy arm, which is measured in this economic policy uncertainty index. And we're putting out a piece. My colleague Arzu is putting out a piece today about the impact of uncertainty on the economy. And so this is a great illustration of the challenges. One of the things that the Fed or the challenges for policymakers is they're creating more uncertainty. And maybe the Fed is saying that's okay at the moment because we want people to be a little bit more cautious in their decision making. But nobody wants a default, and that would be horrendous for the economy. And that uncertainty is really bad.
Okay, yeah, good to bring that up. And you're correct that that piece on uncertainty is up this morning at kenaninstitute.unc.edu if people want to check that out. We do have some questions now, so you can unshare your screen and we'll dig into what we have going here.
Okay.
First question is from Dan Barkin at Business North Carolina. He says, if the labor force is so tight, how can employers create 517,000 new jobs? Where are these people coming from?
So I mean, there's always a pool of people who are well. It's a good question, Dan, and I think we're still at the point at which we're still soaking up some labor that came off of the pandemic, and we're out of the labor market, and you kind of saw that in the labor force numbers. But it's challenging to think about that there were 517,000 new people that just came into the labor market. But and here, let me do a little bit of quick math. As I said, we're about 2 million above the pre-pandemic peak. We're actually exactly, or in this month in February, 3 years from kind of that peak. And if you think about general labor market growth, even with slower population, that number should be roughly 1 million and change. So we're still about 3 million, so that's a total, we should be about 3 million plus jobs higher than we were in February of 2020. And as I said, we're about 2 and change million. So we're effectively still 1 million short of where we should have been given general population growth. But you could argue that population and labor force growth has not occurred. And so that's why we're kind of at this 3.4% unemployment rate. I think, Dan, maybe I'll just say, it's hard to know where they are, but we can't continue doing that without seeing real pressure on wages.
Okay, thanks. And thanks, Dan, for that question. Here's one from Eric Spanberg, who's with the Charlotte Business Journal. 2 questions, actually. He says, do you anticipate a larger rate hike from the Fed at the next meeting? You knew that the question was coming. And how are the jobs numbers' latest trends reflected in the NC economy? Any difference from the national picture?
So I have not, in all my analysis of the numbers, I didn't sit down and kind of contemplate, would they do? Clearly, they're going to they're going to continue to raise rates. They're going to do another 25. I think, and since the meeting is in March, they have another employment report to digest. If we get, if something does, if we get another 500,000, then I'd say then they're going to do more than 25. I'd say another 50 would be on the table, or more on the. I'd say I would advocate for doing 50 base, half a percentage point. If it slows substantially, if there are revisions and the revisions can be meaningful, then that's kind of where and the other piece of the puzzle is the inflation numbers. If you are seeing a meaningful slowdown in inflation, then they could stick with 25. So that's a non-answer, but it's effectively, this is what the Fed is doing. They're data dependent, and the good news for them is they have another month of employment data and another month and they have some inflation data that they'll be able to see before their next meeting. So it's a cop-out, Eric, but it's the reality. If they had to make a decision tomorrow, I'd say they would actually raise 50, but they don't. In terms of the North Carolina economy, we're basically the U.S. economy plus. So we don't get the North Carolina numbers for a little bit, but we've been growing. We've been growing quite strongly. The only downside is that, especially in the Triangle, we've been much more kind of dependent on tech. And so perhaps, and as that chart I is showing that tech is slowing, that could be weighing on us. We're also an area where we have a housing shortage, so that's likely to be a positive in terms of construction. So it's a little, I'd say it's likely it's a positive indicator for North Carolina, with the caveat that we're more dependent on tech, where you are seeing slowing.
Okay. Thanks on that answer, and Eric, thanks for the question. All right, we're at 9:27. We have 3 more questions in the hopper, so pace yourself accordingly.
Okay.
From Barnes Sutton, can you speak more toward the importance of having the 55+ community participating in the labor force?
So this is a really key challenge and key. Thank you for the question. Effectively, because of demographics, ignore anything else, our labor force participation rate has been declining because we just have more people moving into that 55+. If we don't increase that labor force participation rate, then what's going to happen is and we don't have any immigration. And there's a question out there. I think I'm going to answer that question as well, which is that we need that. If we're getting these job growths, we need that immigration to soak up that demand for employment. But if we don't get increases in labor force participation, we don't get increases in immigration, we're not going to be able to have a lot of job growth, which is a key driver of economic activity. Because without it, we're just dependent on productivity. That's how Japan is growing. It's all about productivity for them. And so, but we have their means to increase those participation rates for 55 and older. The other area are female participation, where even the prime age, the 25 to 54, we're well below European levels. And so with things like paid leave and healthcare and childcare, we can, or paid leave and childcare, we can increase those participation rates for females in the prime age, that kind of 25 to 54, and then other benefits to increase other ways of increasing participation at 55+. So we do need those workers if we're going to continue to grow at the same pace as before. If not, we're totally dependent on productivity.
Okay, and you touched on a question from Jeff Miller about the potential impact of the administration increasing immigration. Anything else more to say on that?
The other thing I would say is that in much of these immigration changes are for more skilled labor, and that's really where we have a lot of deficiencies. And we wrote a colleague of mine wrote a piece on the impact of immigration on skilled labor and on our general innovation And so Rob will make sure to send that piece out. So immigrants are a source of labor, but they also tend to be a source of skilled labor, or they, and that's because of our general immigration policy biases towards skilled labor. But they're a big driver of innovation.
Okay, thanks on that. All right, one more question. This is from Barbara Sinich. I hope I got that last name right. Other than adding to uncertainty, how does the substantial growth in government debt, coincident with the pandemic, influence Fed decisions regarding interest rates, if any?
It's a good question, Barbara. So it's not the level of debt that's creating well, you could say the level of debt may create uncertainty, but it's really the potential for default. And I'm just going to say that the debt limit is there's only two countries that have debt limits or debt ceilings, us and Japan. Every other country realizes that when Congress, when the government decides, or the federal, the parliament or the Congress decides to spend more money than they take in, they need to just let the debt increase. And that's what Congress is doing. This is not a left-right issue. It's Congress is spending more than they take in. Once they make that decision, they just should be increasing the debt limit, or we just shouldn't have one. So what we're kind of creating this uncertainty, even though we rolled the dice many years ago or every budget, we've rolled the dice to create this debt limit. It's maybe not rolled the dice. We've created the situation to create this debt. And so we should just be funding it. So what the debt limit does, though, is that the uncertainty that it's potentially creating, and if, God forbid, if we had a default, because that would be terrible, it will cause the Fed to say, wait a second, if we have this uncertainty, that's going to have a negative impact on the economy. And then maybe we should not be raising rates, and maybe they ultimately will need to cut rates because of that uncertainty. We're not there yet, as illustrated by the 517,000. And I think the debt limit is really not a problem until June, when the Fed runs out of when the Treasury runs out of extraordinary measures. But I hate to see all this wrangling and this creation of uncertainty because of that. So we keep an eye on it, and unfortunately, I don't think for political reasons it's going to go away.
All right. Yep. One more thing for us to watch in the coming months.
Exactly.
All right. Well, they say life is a marathon, but this briefing has been a sprint. Thank you very much, Gerald, for your insight, your quickly formed insight after some surprising news this morning. But it's always a pleasure.
All right.
And thank you very much to our attendees, who, as always, had great questions. We appreciate it. It helps make the briefing go. For the press in the audience today, we'd love to continue the conversation. If you have questions for Dr. Cohen or any of our other experts about what we've just talked about, or about anything else you may be working on, please reach out to me, Rob_Knapp, at Kenan-Flagler.unc.edu. We hope all of you will check out our website, which is at kenaninstitute.unc.edu. It's a great way to get an idea of the full range of the research and the writing we're doing. We have Kenan Insights. We have commentaries, including the one that Gerald mentioned this morning about uncertainty that's up. We have videos. We have information on our live and virtual events. So there's plenty for you to check out there. We hope you do. There's also a link to the American Growth Project, which we started in October. It's our look and our insights at the microeconomies across the U.S. There will be something new coming this month there. So it's something else that's definitely worth taking a look at. We hope you'll join us next month. And here's the trick. We hope you join us next month on March 10th. Not March 3rd. Normally, the employment reports drop on the first Friday of the month. In March, it will be the second month. So if you show up on March 3rd, we will not be here. March 10th, we hope to see you then. In the meantime, thanks for attending, and enjoy the rest of your Friday.